Right now, at $3.30 a share, Wall Street is pricing Grab like it's just some failed pandemic darling. But if you actually look under the hood, something massive has just shifted. We are looking at a fundamental valuation gap, and the broader market is completely missing the real story of what's happening inside this company today.
Basically, there's a massive tug of war happening right now, and the market is pulling in the completely wrong direction. See, Wall Street is still terrified of a broken, cash-burning business model. They're deeply scarred by Grab's post-IPO history. But the most recent data? It reveals something entirely different. It shows a rapidly scaling, cash flow-generating engine that is just being wildly mispriced. So let's unpack this and see exactly how Grab is actually making its money today. Section 1. The Southeast Asian Engine and How They're Commercializing Density. Okay, to understand this, you have to realize that Grab isn't just a ride-hailing app, and it's not just a food delivery service either. What they're actually doing is commercializing localized physical network density across more than 900 cities in 8 different Southeast Asian countries. Their proprietary mapping tech can navigate narrow side streets and informal pickup points that giant global competitors literally just can't match. And this creates a crazy strong moat. It's a highly capital-intensive, 3-sided network effect. First, you have consumers locked in through the Grab Unlimited subscription. And get this, those subscribers generate 2.4 times higher gross merchandise value than non-subscribers. Meanwhile, you've got drivers relying on their turbo routing for optimized earnings and merchants depending on Grab's AI-enabled advertising to actually drive their sales. It creates these incredibly high switching costs that make it structurally brutal for any competitor to break in. So if the network is really that strong, why on earth is the stock sitting at $3.30? Let's look at Section 2, the market's blind spot. What is Wall Street actually so terrified of?
Well, the market is laser-focused on 3 very specific threats right now. First, they're terrified of margin-crushing price wars in Indonesia, specifically driven by their main rival, GoTo. The fear is that if Grab is forced to heavily discount just to maintain their market share, their margins are going to completely evaporate. Second, there's the constant looming shadow of regulatory caps on driver commissions across all these different jurisdictions. And third, that $600 million acquisition of Delivery Hero's foodpanda business in Taiwan. This is a big deal because it's Grab's very first expansion outside of Southeast Asia, and Wall Street is highly skeptical of the operational integration risks there.
Honestly, that bear case sounds pretty logical, right? Until you look at Section 3, the Q1 2026 evidence, because the actual numbers completely shatter that pessimistic narrative. You have to appreciate the sheer scale of the inflection happening here. The hard financial proof, reported on May 4th, 2026 for the quarter ending March 31st, is just undeniable. Group revenue hit $955 million. That's up 24% year over year, beating consensus estimates. But the real story is that GAAP net income line, a $120 million profit. Think about that. That is a staggering 1,100% year-over-year swing. They surpassed consensus analyst models for basic EPS by nearly 89%. The operating leverage in this business is finally actually kicking in, and it's happening incredibly fast. But out of everything, this is absolutely the most important number in this entire analysis. $489 million. That is Grab's trailing 12-month adjusted free cash flow. This is the definitive, undeniable proof that Grab has transitioned from a subsidized growth story into a self-sustaining economic engine. They are not burning cash to survive anymore, they are generating it. Now, financial momentum is great, but what about the actual operational health of the company? Let's check out Section 4, the quality scorecard, and run a quick business health check. So based on the fundamentals, we're looking at a blended score of 7.9 out of 10. And the contrast within these numbers is what you really need to pay attention to here. The lowest score is their track record, a 6 out of 10. Why? Because investors are still deeply scarred by that post-IPO cash burn era. But then look at their financial health. It's a 9 out of 10. Grab is sitting on an absolute fortress of a balance sheet with $5 billion in net cash liquidity and a debt-to-equity ratio of practically 0, just 0.06. And they're actually using that cash to execute a $400 million share repurchase program. The market is so busy pricing in the history of their track record that it's completely ignoring the fortress balance sheet they hold today. And hey, by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. All right, moving into Section 5, I want to quickly mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.sentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 different investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video, scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.sentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 6, Scenario Analysis, and our 5-year projections. Before we dive into the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. With that said, let's look at the 5-year model out to fiscal year 2031.
The crucial thing here is understanding the actual operational assumptions that drive this math. In our base case, we assume steady digital consumer spending expansion and a successful integration of foodpanda Taiwan. Under those conditions, revenue reaches $8.19 billion, and with AI-driven matching efficiencies, GAAP net income margins hit 10%. We're applying a 25x exit multiple there. In the high case, stronger digital banking penetration, thanks to Superbank, pushes revenue up to $9.31 billion with a 12% margin and a 30x multiple. But we have to look at the downside. In the low case, if those regional price wars reignite and regulatory caps hit hard, revenue stalls out at $5.98 billion, margins collapse to 4%, and the multiple contracts down to 15x.
When you actually map those operational outcomes to the stock price, the contrast is pretty wild. The base case yields an implied year 5 share price of $5.39. That offers a very solid 10.31% annualized return. The high case, that targets $9.31 for a massive 23% annualized return. But again, that low case drags the stock all the way down to 90 cents, which would completely break the investment thesis and your portfolio right along with it. So to figure out the true implied value today, we have to apply probability weighting. Based on the fundamental momentum we're seeing in this latest quarter, we assign a 60% probability to the base case, 25% to the high case, and 15% to that low case. And just a quick reminder, if you want to really dig into this, you can access this full detailed model with all the underlying assumptions for free at flash.stocksentinel.ai. When you run all that probability-weighted math, the target price comes out to exactly $5.70. Compared to the current trading price of $3.30, that implies a massive 72.7% asymmetric upside. The market is pricing this thing like a broken company, but the math is telling us it's a rapidly scaling, highly profitable network. But look, we have to be intellectually honest here. Section 7, what could actually break this? Let's talk about the risk factors, because there are concrete, real-world threats that could absolutely drag this stock down toward that 90-cent low case. Here are these specific early warning signs you absolutely must watch. First, a flawed migration of the foodpanda Taiwan platform by 2027. If merchants and users start experiencing disruptions, that projected $60 million in incremental EBITDA, it vanishes. Second is credit risk. Grab fully consolidated Superbank in May of 2026. Their gross loan portfolio is now sitting at $1.4 billion. If loan delinquencies spike above 4.5%, the impairment provisions will absolutely gut their financial services margins. And finally, if consumer incentives rise above 6 or 7% of GMV, that is a massive red flag. It signals that organic demand is softening and Grab is being forced right back into those margin-crushing discount wars. Section 8, the final verdict. Bringing this all together, why exactly is the market wrong here? Ultimately, here are the 3 things you need to take away from this explainer. First, Wall Street is still blinded by their post-IPO bias. They are completely ignoring the fact that Grab has definitively transitioned to a nearly $500 million free cash flow model. Second, their $5 billion fortress balance sheet heavily insulates them against regional macro shocks, and it allows them to aggressively buy back their own shares. And third, the probability-weighted math reveals a massive valuation gap, implying a 72% asymmetric upside right now. The immediate catalyst you need to be watching is actually happening right now. Management is expected to update their full-year guidance on the Q2 earnings release dropping today, August 3rd, 2026.
you're going to want to pay very close attention to how the superbank consolidation impacts the reported revenue outlook.
So will Grab cement its status as the unstoppable cash engine of Southeast Asia, or will the weight of regional price wars drag it back down to earth? The math is definitely pointing to a massive upside, but as always, only time will tell. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.